The stock market didn't suddenly become smarter. It became faster. So fast that by the time you decide to buy a stock, the decision has already been made by something else. Not a hedge fund manager in a glass tower. Not a trader screaming into a phone, but a machine. And the uncomfortable truth is this: when everyone is using AI in the stock market, the market itself stops behaving the way you think it does. And that changes everything. Let's start with why this matters right now. Because for most of the last 100 years, the stock market ran on human limits. Humans could read reports. Humans could interpret news. Humans could panic. Humans could get greedy. Speed was capped by biology. Today that cap is gone. AI doesn't read earnings reports, it ingests them. It doesn't react to news. It predicts reactions before the news is even finished uploading, and crucially, it doesn't sleep. Right now, more than half of all stock market trades in the US are executed by algorithms. Not suggestions, not analysis. Actual buy and sell decisions. And AI is rapidly taking over the rest. So the real question isn't, can AI beat humans in the market? That already happened. The real question is, what happens to a market when everyone uses the same kind of intelligence? To answer that, we need to rewind. Because the stock market wasn't built for this. Originally, markets were slow and deeply human. You bought a stock because you believed in a company. Or because someone you trusted did. Prices moved over weeks, months, years. Even professional investors were still constrained by time. Then computers showed up. At first, they just helped humans calculate faster. Spreadsheets, databases, charts. Nothing revolutionary. But in the late 1990s, something subtle changed. Firms realized that if you could react milliseconds faster than another trader, you could make money without being smarter. Just faster. This gave birth to algorithmic trading. Simple rules at first. If price moves X, do Y. If volume spikes, sell. No thinking, just execution. Then data exploded. News feeds, satellite images, credit card transactions, social media sentiment, and now AI enters the picture. This is where the market quietly breaks, because AI doesn't trade like a human. It trades patterns. An AI model doesn't care why a company is doing well. It cares that historically, when these 10 variables line up, the stock moves up 1.7% over the next 48 hours. That's it. No story, no belief, no loyalty. And when one firm builds an AI that finds these patterns, it works for a while, until everyone else builds the same thing. This is where the uncomfortable math shows up. If 10 AI systems are trained on similar data, using similar techniques, they don't diversify the market. They synchronize it. Instead of many independent opinions, you get one amplified reaction. Think of it like this. In a human market, bad news spreads unevenly. Some people sell immediately. Some wait, some buy the dip. In an AI-dominated market, the reaction is instant and uniform. The moment a signal flips from green to red, thousands of algorithms hit the sell button at once. Prices don't move. They gap. And this isn't theoretical. We've already seen it. In 2010, the market crashed nearly 10% in minutes. Then recovered almost as fast. No war. No earnings collapse. Just feedback loops, algorithms reacting to algorithms. That was before modern AI. Today, those systems are far more sophisticated. They don't just react to price. They react to other algorithms reacting to price. This is where things get strange. Because AI doesn't just predict fundamentals, it predicts behavior. If an AI believes other AIs will sell, it sells first. Not because the company is worse, but because being early matters more than being right. So what does the stock market become? It becomes less like a voting machine and more like a reflex test. This creates a massive disconnect between hype and reality. On the surface, we're told AI makes markets more efficient, more rational, more informed, and in some ways, that's true. Prices incorporate information faster than ever. But speed is not the same as understanding. AI doesn't ask whether information matters, only whether it moves prices. That leads to absurd outcomes. A vague headline triggers billions in trades. A rumor spreads before it's verified. A corrected story barely moves the needle because the trade already happened. The market reacts first and thinks later. If it thinks at all. This also changes who actually wins. Because when everyone uses AI, alpha disappears. If every model spots the same opportunity, the opportunity no longer exists. Returns compress. Edges vanish. So firms push their systems harder, more leverage, more speed, more complexity. That's how small signals turn into large risks. Because AI doesn't understand consequences. It doesn't understand that selling aggressively can cause the crash it's trying to avoid. It just executes. And when many systems share that logic, instability becomes a feature, not a bug. Zoom out further. What happens to long-term investing in this world? It doesn't disappear. But it becomes background noise. AI-driven trading dominates short-term price action. That means stock prices increasingly reflect positioning, not value. Companies can be fundamentally strong and still experience violent swings, not because investors changed their minds, but because models rebalanced. This also creates a strange irony. I was supposed to remove emotion from markets. Fear, greed, panic. Instead, it industrialized them. Fear now spreads at machine speed. Greed compounds instantly. Panic becomes a technical signal. And humans are left trying to interpret moves that no longer have a clear narrative. This is where the risk becomes systemic. When humans ran the market, mistakes were slow. When machines run the market, mistakes are synchronized. Everyone exits together. Everyone enters together. Liquidity disappears exactly when it's needed most. And when something truly unexpected happens, not in the data, not in the training set, AI doesn't adapt, it freezes. Or worse, it reinforces the wrong move. This raises a question regulators quietly worry about. If the next financial crisis isn't caused by bad loans or fraud, but by perfectly rational machines amplifying each other, who's responsible? You can't jail an algorithm. You can't cross-examine a neural network. And you can't easily turn these systems off without breaking the market they now support. So where does this leave the average investor? Here's the uncomfortable answer. You are no longer competing against other people. You are competing against systems that see more, react faster, and never hesitate. But you're also not completely powerless. Because AI still has blind spots. It struggles with regime changes. It struggles with truly new events. It struggles with long-term patience. The irony is that in a market dominated by machines, the most human traits regain value: time, conviction, the ability to sit still while prices thrash for reasons that don't matter. But even that isn't guaranteed. Because as AI continues to learn from itself, the market becomes increasingly self-referential. Prices move because prices moved. Signals trigger signals, reality lags behind. Which leads to the final unsettling thought. If the stock market is supposed to be a reflection of the real economy, what happens when it's mostly a reflection of its own algorithms? At what point does the market stop telling us anything meaningful at all? And when that happens, how would we even know?